Good day, welcome to my channel. This is Kevin Davis Accounting. So today I would like us to see how we work out centrally controlled branches where goods are being sent at a selling price. Now we said that once goods are being sent at a selling price, we prepare 7 accounts. Remember, in the previous video we prepared 6 accounts because goods were being sent at cost. Here we're going to look at where goods are being sent at a selling price. Now, once goods are being sent at a selling price, we add on the 7th account, which is called the branch inventory adjustment account. Now, when we have a balance brought down here, for example, and the balance brought down, I assume it is 80,000. Now, this is stock at the branch that we had in the previous year. And because this is the opening balance, obviously we are supposed to find the profit on it. So how much is the profit that's supposed to be realized on the opening balance of the inventory? So when it comes to this 7th account, in our previous video, we're talking about the gross profit being determined here. Now when it comes to the selling price, the gross profit is going to be determined from the branch inventory adjustment account, meaning that anything that has a profit element on it will be catered for in this account. Now, something to note is that this account records selling price. It records items at selling price. That means if they say we sent goods at a selling price, maybe 20%, it means you're going to record them in this account the way they are. But then, the goods sent to branch account records cost. So it means that if we send goods to the branch, okay, the head office is sending goods to the branch, it means when you're recording the goods sent, if those goods have been sent at the selling price, when it comes here, you're going to record those goods at the selling price. When it comes to the branch inventory account, you're going to record those goods at the selling price. But rather, when it comes to the goods sent to branch account, we are only going to record the the cost element of it. Now, the profit element, which would have been inclusive, that don't have been in the selling price and not in the goods sent to branch account, is going to be recorded in the branch inventory adjustment account. So meaning, for example, if you send goods and the goods you have sent are worth, let me say 100,000, and I'm going to assume that this is the selling price. So if this is the selling price, it means I'm going to record here goods sent to branch at 100,000. But I assume that on those goods that are worth 100,000, I have put a markup. And the markup that I've put there is actually, let me say 20,000. So 20,000 is the profit element. So meaning that I have 100,000 as my selling price, and then I have 20,000 as my profit element. So meaning if I get selling price minus cost price, it should give me the profit element. So simply I have the selling price, which is 100,000, and then the cost price is what I'm looking for, because once I'm recording the items here, I'm supposed to record them in their cost element. So I'm looking for the cost price, so I say it is equals to the 20,000, which is the profit. But remember, once these goods are being sent at selling price, it means that the profit is already included here. Now, if the profit is already included, it means that obviously now the profit element I'm going to get is 20,000. So for me to get my cost price, I'm going to say cost price equals to 100 minus the 20, which is going to give me the 80,000. So my cost price then becomes 80,000. So it means that once I'm recording under the goods sent to branch account, I'm going to record branch inventory, and then I'll put 80,000, because the cost of the good that was sent is 80,000 as much as it was sent at 100,000. So 100,000 is why we see that there's a markup. Now, there is one of the ways that you have to do that to find out this. For example, if they say goods are being sent at a selling price at a cost plus maybe 10%. Now, Obviously, when they say selling price, obviously that is a margin. That means goods are being sent at a margin. So what you're supposed to do, for you to find the markup, you're supposed to change the margin to markup. So meaning, how do you change from margin to markup? The easiest way you can change from margin to markup, you're going to say, let me assume it's 10% here. It's 10 out of 100. This is the percentage that they've given us. So they're saying that goods are being sent at a selling price of a cost plus. So meaning if it's cost plus, first to change it to markup, you're going to maintain the numerator, and then you're going to get the denominator plus the numerator. So that means for you to get the markup, you're going to get 10 out of 110. This is one of the ways, the quickest ways you can find or you can change from margin to markup. So meaning, if they give you 1 out of 4, and then they tell this one from margin to markup, you just have 1 out of 4 plus 1. Therefore, our markup will be 1 out of 5. So this is one of the easiest ways on how to do markups and margin, changing from margin to markup. I have a video concerning change from margin to markup. You can look it up and then get more information about margins and markup. So when it comes to the branch goods sent to branch, once goods are being sent, remember that this account records cost. So once goods are being sent to branch, we say the dow entries debit the branch inventory, then you credit the goods sent to branch account. But now remember that these two accounts now are recording two different items. This one records that cost, this one records that selling price. Now, for example, in this scenario, we have recorded 100,000, which is the selling price, and 80,000 being the cost. So where does that 20,000 now go? Now the 20,000 goes to this account here, the branch inventory adjustment account, which only records the profit element. So meaning that the profit elements now are going to be recorded under the branch inventory adjustment account. Now, it is on the credit side here, therefore I'm supposed to bring it on the credit side and I say branch inventory 20,000. So, as you can see, 20,000 on the credit plus 80,000 on the credit should give me 100,000 on the debit. So, once it comes to the goods sent to branch, we're supposed to first get out the profit element and then record it in the branch inventory adjustment account on the credit side. So that is how we do the profit elements from the branch inventory adjustment account. Now, the question could be, how do I get to know that this is a transaction that I should cater for or a transaction that I need to take off the profit element? One, that transaction has to be a movement between the branch and the head office. Once you see the movement between the branch and the head office, because the branch inventory account is here and it's recording what? Selling price. But rather, the goods sent to branch, this is where we find like the head office. So if there's a movement between these two accounts, obviously you're supposed to record the cost element and the profit element. And also, if you see when they say an item, for example, they say maybe returns from branch to head office. So remember still, once the returns, imagine you're returning goods now from the branch to the head office. So still, the returns will be of what? Of a selling price in the branch inventory account. But when it comes to the goods sent to branch account, you're supposed to take out the profit element and then you record the cost here, then the profit element will be recorded here. So meaning that once you see movement between the branch and the head office, therefore you're supposed to take out the cost component and then the profit component will be recorded under the branch inventory adjustment account. Then also you could have things like goods stolen at invoice price. Now these are other items that can come in. If you see goods stolen at invoice price, obviously here when once goods are stolen, you're supposed to record, you're supposed to come and credit this account to show that you're losing stock and then take it as an expense. But if the question says that goods were stolen at an invoice price, it means you're going to write the goods stolen at the selling price or the invoice price, then take out the profit element, and then the cost is what you're going to record under the branch expenses. That is how you can know when to record in the branch inventory adjustment account. So you can only record there when one, there's movement between the head office and the branch, Also, if you see anything that is at maybe at selling price and its corresponding account, for example, I've given goods stolen. Once goods are stolen at invoice price, you're supposed to take out the invoice price here, then calculate its profit element and place it under the branch inventory adjustment account, and then the balance, which is the cost, should be recorded under expenses, because expenses should be recorded at their cost. So that is all about that, the selling price. These are just a few adjustments that you're going to include in. Then also, the very first items to record in this account, once you're recording in this account, we are going to have a balance brought down. Now, the balance brought down will be here. Now, once you have a balance brought down of branch inventory, that balance brought down, there is a profit element expected out of it. Now, I assume that goods were being sent at 10%, so which is 10 out of 110. So you multiply by the balance brought down here. So once you multiply by the balance brought down, you're going to get the markup. And the figure that you're going to get is the profit element expected. Is the profit element expected from the opening stock or from the opening inventory. Now, it means that once you get the balance brought down, add the markup, then multiply by the markup, and then the figure that you're going to get should be credited to the branch inventory adjustment account. So this is on the debit side here. Now, since on the debit side, you bring it on the credit side here, and you show that this is the profit expected. Now, still the same applies to the balance carried down. So once you have the balance carried down here, obviously there is a profit element. Now, because it's the profit element, still you're going to find the markup times the closing stock or the closing inventory, and then the figure that you're going to get is going to be debited to the branch inventory adjustment account. Since this is on the credit side, you bring it on the debit side here. So that's one of the things that should be included within the branch inventory adjustment account. Some of them we shall see them as the question goes on. So allow me to rub off this and then we'll start up a question. All right, the question says, KDA Limited has its head office in Kampala City and a branch in Mubende. It sends to the branch goods at a selling price at a cost plus 20%. The following information was given at the end of 2025. So they have given us stock at 1st January 2025 at selling price is 5 millions. Then we have receivables at 1st January 2025 as 1 million. Then we have goods sent to branch at invoice price of 12 millions. Then we have goods returned by customers of 800,000. Then we have goods returned to head office by branch of 500,000. Then we also have cash sales of 5 millions. Then we also have credit sales of 6 millions. Cash received from debtors of 2 millions. Then we also have bad debts of 400,000. Discount allowed of 200,000. Then expenses at the branch, we have sales of 800,000, electricity of 100,000, petty cash of 100,000, and then stock at 31st December 2025, which is the closing stock, is 4,500,000. Required, prepare the necessary ledger accounts in the books of the head office. So that's the question that we are going to do, and so we are going to start. So they've given us, they're telling us that KDA Limited. These are in the books of KDA Limited. So in the books of KDA Limited. So as we start, they've told us that we have a balance brought down, and the balance brought down, if you check in the question, is 5 millions. So we have a balance brought down of 5 millions. Now, remember they told us that once these goods are being sent, they are sent at a cost plus 20%. So it is 20%. So it is 20 out of 100. So once we turn it to markup, it's going to be 20 out of 120. So meaning that for us to find the markup, we're going to say 20 out of 120. So on this opening stock, we have to get the profit that was realized out of the opening stock. So meaning you're going to say 20 out of 120 times the 5 millions. Like this. So that means we want to find out how much profit was realized from our opening stock. So we are going to get 833 like this. So now, this one being on the debit side, we're supposed to take the profit component of the opening stock to the branch inventory adjustment account. And therefore, our balance brought down will come here as 833 like this. So this is the balance brought down coming from the branch inventory. So we're just trying to get the profit element out of the other account, and then we bring it to this account. Then the next transaction says, that receivables at 1st January 2025 is 1 million. So our receivables is here. So we say balance brought down is 1 million like this. So we are only making a movement whereby if you see movement between branch and head office, that's where we're going to apply the markup. So that is the transaction that was supposed to enter. Then the next transaction that says that goods sent to branch at invoice price of 12 millions. Now, I said that once goods are being sent to branch, we are going to debit the branch inventory account, and then we are going to credit the goods sent to branch. But rather, the goods sent to branch account records transactions at cost, and yet the branch inventory records at selling price. So it means they have told us that goods were sent, so we say goods sent to branch, which is 12 millions. Now, we are supposed to record the 12 millions in that account because that account has no problem with recording the selling price. But then we have a problem recording it here because this account only records the cost. So that means you're going to get the 20 times the 12 millions. First, we get the profit component on the 12 millions, and it's 2 millions. So meaning that the profit component out of the 12 millions is 2 millions. Therefore, once you get 12, which is the selling price, minus the profit of 2 millions, we are going to get the 10 millions, which is the what? Which is the cost. So meaning, once you are recording under goods sent to branch account, you're going to record branch inventory, and then you're going to record the 10 millions. And then you're going to get these 2 millions, which are the profit element, and then we credit it here in the name of branch inventory, and then you get the 2 millions as well. So if you see, the 2 millions plus the 10 millions, both on the credit side, should give us the 12 millions on the debit side. So that is how we enter these transactions in the branch inventory adjustment account. Then the next transaction, they're telling us that goods returned to head office by branch. So goods returned by customers first. Now, we have goods returned by customers. Obviously, we say that once customers are returning goods to us, we are going to come here and credit, say returns, which are going to the branch inventory. So the returns that they were worth 800,000. So you put 800 here. And then you come here and say returns, which is coming from the branch debtors of 800,000. So that is the entry that we're supposed to make. So we have the returns there. Then in the next scenario, they told us that there are returns from the branch to the head office. Now, the question is saying that we had goods returned to head office by branch. Now, once goods are being returned to head office by branch, it means we are still having a movement between the branch and the head office. So, meaning that the goods that were returned, you're supposed to come and say returns. Obviously, it's going to goods sent to branch, which is worth 500,000. But then, I can't record this same figure here because this account is recording at selling price. That means I have to first get the profit element out of it, and I place it here, and then the cost element should come to the goods sent to branch account. So I'm going to get, it will be 20 out of 120 times the 500,000, like this. So this is going to give me 83,333. So meaning that this is the profit component that I'm supposed to get out of the returns. So the profit component out of the returns is 8333. Then once I get 500 minus 8333, I'm going to get 416667. So meaning that this amount here is the cost element of the 500, and then 8333 is the profit element. That means when I come here, I'm going to record returns which are coming from the branch inventory, and then I'm going to put 416667, and then still on the debit side carry the same figure here, and then I say returns. Obviously going to the branch inventory, it's going to be 8333 like this. So that's how we enter this transaction. So once goods are sent and goods are returned, please, you're supposed to record the cost element out of it, and then you take the profit element to the branch inventory adjustment account. Then the next transaction, they are telling us that we have cash sales of 5 million. Now, we said that once there's cash sales, obviously we are going to show a reduction in the branch inventory. So you say cash sales, which is what is going to the branch cash. So the cash sales were worth 5 million. So you come to the branch cash and you debit cash sales coming from branch inventory worth 5 million as well. So that's the double entry. So once you make the sales, obviously you're going to debit the branch cash to show an increase in the cash at the branch, and rather it's supposed to show a reduction in the inventory at the branch as well. Then the next transaction is talking about credit sales. Now, I said that when it comes to the credit sales, you must show a decrease in the inventory at the branch. So that means you're going to record the credit sales here, which is what, 6 million. Now, what brings about the credit sales is when you have the data. So when these people take goods on credit, these are credit sales. So we come here and we debit the credit sales, and then we put the 6 million here. So that's the transaction that we're supposed to enter. Then the next one, they are saying that we have cash received from the debtors of 2 million. Now, once we receive cash from the debtors, we must show that the amount of money that we're demanding the debtors is decreasing, and then we show an increase in the branch cash. So you come here and say cash received. Obviously, this cash received is going straight to the branch cash. So it's going straight to the branch cash, and then it is 2 million. Obviously, we come and debit the branch cash in the name of cash received, which is coming from branch debtors. So it is 2 million. So it is coming from the branch debtors. It is 2 million. Then the next transaction is that we have bad debts of 400,000. So bad debts, these ones are affecting the branch debtors account. So you bring the bad debts here. Bad debts being 400,000. We said that bad debts are expenses, and because they're expenses, we're supposed to take them to the expense account and we debit them. So we say bad debts of 400,000, like that. Then also we have the discount received. Discount received is of 200. Now discount received also should be here. So come and say discount received, which is 200,000. Now here we have created it here. Then so it is allowed. Sorry. So it's discount allowed. Then we can say discount allowed as well here of 200,000. So that's how we have entered this discount allowed, because it's an expense. That's why we are debiting it here, and then we are creating the branch debtors account. Then they are telling us that expenses at a branch, we have salaries of 800, electricity of 100, and petty cash. Now all these are expenses, but then they are being paid out of cash. So you have salaries which were worth 800. So you come and debit the branch expenses account, size of 800,000. And then we are going to have electricity of 100,000, and then electricity here of 100,000, and then we are going to have petty cash of 100,000, and then shall have petty cash of 100,000. So these are the transactions that were supposed to enter within the books. Now we are going to close up these accounts, but before closing up this account, remember they gave us a balance carried down for branch inventory. So supposed to bring that balance carried down here, which was 4,500,000. So that was the balance carried down. Now, once we are closing up this account, the branch inventory account, ideally this account should be equal. The debit side and the credit side should be equal. Now, if they're not equal, then obviously the balancing figure, now for example, look at this. On the debit side, we have, this is 17,800,000, and then the credit side, we have 16 millions. So meaning that we're going to have 17,800 and then 17,800. Now, if we were in the other account where goods were sent at cost, obviously it would have been a loss here. But then, when it gets 17,800,000 minus the 16, you're going to get 1,800,000. Now, this 1,800,000 is what we call the abnormal loss. So 1,800,000 is what becomes the abnormal loss. Now, the thing is, I say that an abnormal loss obviously is an expense. Like any loss should be, any loss is an expense to the business. But now, this abnormal loss is at selling price because it is in the account that we call selling price. So meaning that we're supposed to get the abnormal loss and also get the profit element out of it. Now, the same thing is going to apply to our balance carried down. Our balance carried down, we are also supposed to get the profit element out of it. So now, if you check to the question, we're supposed to come and get the profit element out of the what? Out of the balance carried down our inventory. So it means we are going to get 20 out of 120 times the 400, 4,007,000. So meaning that we're supposed to get the profit component on this. But then also we're supposed to calculate the profit component on the abnormal loss that we are getting. And so once we calculate that, in the question we are going to get our balance carried down. Here we're going to get 750,000. So meaning there is a profit component of 750,000 that was not realized on this closing stock. And so because it's on the credit side, I'm going to come here and say balance carried down, it is 750,000. So I bring it on the debit side. Then I also compute for the abnormal loss. The abnormal loss, it is 1,800,000. So once I compute for the profit element, I am going to get 300,000. So meaning that the 300,000, now I'm going to get 1.8 minus the 300, which is going to give me 1.5, which is 1,500,000. So meaning that the actual expense that the business suffered is 1,500,000. So abnormal loss is 1,500,000, and therefore I'm supposed to record the element of the profit element of the abnormal loss as 300,000. So that's how we're supposed to do our account. Now, usually once you're closing up this account, like I said, it should dissolve itself. So if it doesn't, then the balancing figures will become the abnormal loss. So we can balance off the other figures as well. So we have, we can balance off this. This is 10 millions, and then 10 millions here. Therefore, we're going to have a trading account here as the balancing figure, and then the trading account is going to be 9583, 9583, 333. That's the closing figure here. Then also, when it comes to the branch debtors account, once you're closing it off, you're going to have 7 millions here. 7 millions and 7 millions. And then we're going to have a balance carried down, and now balance carried down is going to be 3,600,000. And then also we come to this account as we are closing off the account. Now, in the previous video, we looked at our gross profit being determined in the branch inventory account. Now, in this video, our gross profit is going to be shifted to the branch inventory adjustment account. So meaning that we are going to determine our gross profit from this account, because this is the account that we call the profit elements. So if you see how our branch inventory adjustment account is working out, we are going to get 2,833,000 like this. The same applies this side. And then our gross profit that we're going to take straight to the branch profit and loss is going to be 1,700,000. So that's the gross profit that we are getting. That means that that gross profit should be transferred to the branch profit and loss. So we bring it on the credit side, since it's on the debit side there. So we say gross profit, which is 1.7 millions. And then we can also balance off these other accounts. So once we balance off this, you're going to have 7 millions here and 7 millions here. And therefore our balance carried down is going to be 6 millions. Then when it comes to this, once you're balancing off this account, our expenses account, you're going to have 3,100,000. 3,100,000. Therefore, our profit and loss, you're going to take, this is branch profit and loss, you're going to take 3,100,000. So this is the figure that you're going to take on the debit side of the branch profit and loss account. So we show that it's from the branch expenses account and it's worth 3,100,000. So once we balance off this account, you see that now the debit side is outweighing the credit. So meaning that you're going to have 3,100,000 and 3,100,000. Now, obviously this is a net loss. So our net loss is going to be 1,400,000. So that's the net loss that the business made. By us doing this, we are done with our transactions being entered at selling price in the books of the head office. So thank you so much for watching. This is Kevin Davis Accounting. In the next video, I'm going to be handling autonomous branches.